Mintedseed welcomes you once again. This will be the first topic in our education program. Here we want to first emphasize on all the basic and fundamental concepts that revolve around trading the foreign exchange. First of all, we would like you to open up your minds to receive new ideas and information. Some of you may be new to the business, and we want to make it our duty to provide you with the most reliable trading education that you may find. We ensure that the content is informative and applicable to most trading environments. And for the experience, we do hope to add on to your knowledge. Alright? Although some elements may differ from traditional methods or teachings, these were all based on our accumulated experiences instead of a perfect world textbook example. Okay? So now let us begin. But before we begin, I would first like to apologize if the microphone is a bit too noisy because it's raining quite heavily right now. But I want to get these videos out as soon as possible. Okay, let us begin. The concept of equilibrium points. In other words, equilibrium means balance. Now revolve all your decisions around this concept. Okay, it will actually answer your questions regarding price action, because price action is what most traders believe is the one true method of trading. Now imagine equilibrium points as the ultimate confluence method. So I'm pretty sure most of you have heard of this term, buy low, sell high. In other words, it can translate to buy support, sell resistance. These questions are brought forward all the time. To give you a glimpse on why we actually call this the looping auction house is because there are millions of traders trying to obtain the best price for a specific item. In this case, the item is known as currency. Okay? However, there is a difference. There will never be a fixed or final price, as supply and demand is constantly changing the final level, creating a loop. Okay, now imagine this. You go to an auction house and you start placing your orders. Okay, we call it orders. So let's say there is this antique painting. So you want to get this painting for $1 million. Okay, so the auction house agrees to sell you that painting for $1 million. The next moment, you sell it back to the auction house for $2 million. And the auction house sells it to someone else at 3. And it goes on and on and on and on. And eventually, everyone will start wondering, will have this wondering thought, if this painting is always sold, that means people do not want this painting. Therefore, this painting has no value. So the price of the painting actually drops back to 1 million. So this loop actually happens over and over again. Okay? But Forex is a different type. It is a looping auction house where you never go through a third party. The buying and selling constantly happens within the auction house itself, meaning that you don't go sell the painting to someone else. You only can sell it to the people of the auction house or that are already in the auction house. Okay? So, to continue on this introduction, equilibrium points. Let's get started. But before that, I need everyone, again, please revolve your thinking around equilibrium points. This is what actually gives meaning to your technical analysis, decisions, and trades. So the 3 main points are supply, demand, and equilibrium points. Over here, if you look at the chart, you see 3 colors. One line with blue, one line with red, and circles in the color green. I am not marking support and resistance here. Although it looks like support and resistance for now, this is the very reason why I say revolve your thinking around supply and demand or equilibrium points. Because if I don't say that, the first thing you're going to think when you see this chart is he drawing support and resistance? No, I'm not drawing support and resistance. I'm actually drawing supply and demand levels and where equilibrium actually takes point. We are trying to identify where imbalances are located and where does it actually start. Okay, you can read more about this, and let's get on to the next page. Now understand this, you've been misinformed. There is no competition between bulls and bears. There is no competition between traders. There is no competition between retail traders and institutional traders. The market is just played by one player, the institutions. Only them and them alone. They provide liquidity for us to trade. But in actual fact, we are literally their liquidity too. So you have heard these terms: bulls, bears, long, short, buy, sell, uptrend and downtrend. Bulls, long, buy and uptrend means the market is going up, prices are increasing. It all means the same thing. Bears, short, sell and downtrend means prices are going down. Okay, same thing again. Now understand what is bias, okay? When we mention bias in these lectures, we are talking about imbalances. Not candlesticks, not directions, not competition between bulls and bears, or which side you're on. Although we do not emphasize much on trading the trend, it is still your best bet in probability. That is why price action traders always say the trend is your friend. This is solely based on higher probability. Okay, so this is just a quick introduction on some of the concepts that we are actually going to bring forward later on in the program. So now let's carry on. The next one which you'll be learning about is candlestick structure. Okay, when I first understood about candlesticks, I thought this was it. This is how prices move. I thought that there was some sort of fixed algorithm to it that made candlesticks move in a certain direction. Okay, but actually there is a hidden picture in these candlesticks which people don't actually realize. They don't realize it is not an indicator to identify strength or weakness, as most price action traders claim. Okay, before we actually explain more about it, let's see how a candlestick is actually formed. Okay, each candlestick has some sort of movement, and this is the most basic movement of a candlestick. So first of all, let's identify. The solid shape, which is basically a rectangle, represents the body. The wicks or shadows represents the highest point prices have been to in that particular time frame, or how low it went on that particular period or time frame. The next one is where the candlestick opened. Okay, this one was what I was explaining just now, the lowest point and the highest point, and where it closed. Okay, so you'll always find these explanations about candlesticks. What are wicks? That's the first thing. Wicks, most traders will actually explain wicks as an indication that prices were rejected to go higher or lower. This is because prices pushed back to a certain level but was pushed back near to the close, indicating that the level was rejected. Okay, the next one is, what are bodies? The larger the body, the stronger the bias. The smaller the body, the weaker the bias. Okay, so if you see a large bullish candlestick, most price action traders will tell you that, oh, it's a very long and large bullish candlestick. That means the trend is really, really bullish and it signifies strength and momentum. However, this is wrong, okay? We'll explain more later on. What are the open and closes? This is where prices open and close at a particular time frame or period of which you are in. Okay? Looking at this to identify, most of them look at this to identify confirmation and entries. So they always say, okay, you gotta wait for the candle to close above or below this level. Only then we can confirm to take the trade. Only then we can confirm if it is a breakout or a rejection. This is how they actually use candlesticks, which is also wrong. Okay? And the last one, what are highs and lows? The highest, this is actually identified by the wicks. The highest or lowest prices have actually been in that particular time frame, which also can, they say that this can indicate significant continuation or rejection. Now let us identify the truth of it. Okay, you see the red box? All of that, of what I was actually just saying just now, was all wrong, okay? But before I actually explain, please understand that time frames are the context, okay? If you're on the 4-hour time frame, use that as your context. If you are on the 5-minute time frame, that is your context, okay? Because sometimes a downtrend is actually just a retracement of an uptrend, okay? I'm talking to you in trends now, okay? I will not say that trends do not exist yet. Yeah, okay, to be honest, trends don't exist. But I wouldn't say that just yet, or else you might be too confused, okay? So what are wicks? Of the particular time frame, wicks are indicators of supply and demand of that current candlestick. It has nothing to do with rejection, but rather a search for equilibrium of prices. Bodies, on the other hand, of the particular time frame, large bodies indicate imbalance. That means that there is not enough liquidity. Okay? Most people actually think, oh, there's so much liquidity, that's why momentum actually happens. No, it is because there is not enough liquidity. It is an empty move. Okay? It is an empty move, and it's no different from gaps. You know, gaps sometimes where throughout the week the market actually moves during the weekend. So when it reopens on Monday, you notice that prices actually have a gap. Why does that gap happen? Because during the weekend, retailers were not there to trade. Therefore, that gap actually signifies imbalance of missing retail traders. So a large candlestick does not signify strength, is the strength of momentum. It actually signifies imbalance. Open and close. Of the particular time frame, the open and close have nothing to do with confirmation. It is the collection of distance between the ask and bid of the particular candlestick. Okay, currently right now, most people understand the ask and bid as what actually determines the spread. If you take the ask and minus it with the bid, you get the spread. Well, that is actually not the case, but don't worry. Throughout this series, we'll start to explain what is the ask and bid step by step, okay? So don't try to jump into the whole question right now, or else you might get too confused. Highs and lows of the particular time frame, it is where supply and demand is collected. Put it in terms of accumulation. So, a summary of everything I just said. If you look at the candlesticks, we start from the top there, at the top of the wick. Prices pushed high, but momentum and buyers were decreasing. Then you have the resistance level, then you have strong decision, a lot of buyers in the market, therefore prices moved up. This is correct if we look in terms of pips, but it is very wrong in terms of how prices actually move. Then you have the support level of the candlestick. Then the last one, which is the lowest point, prices pushed lower than the support open, which is the open of the candlestick, then ultimately made the decision to move back up. Okay? Some half-awakened gurus will actually call this a liquidity grab. It's almost correct, but not there yet. Okay, then if you look at a dodgy candlestick, they always say that this is either equal amount of buyers and sellers, or traders didn't know the direction, and therefore there was indecision. But to be honest, all of that is crap. The correct way to look at candlesticks is like this. Okay? So study this carefully. Okay, if you see the first candlestick, you see demand range, you see the supply range, you see the imbalance candle, no liquidity, high spread. Then the next one, you see the dodgy, liquidity, lower spread, it is a balanced candle. Okay, dodgies actually mark very high liquidity. Okay, and if you finally look at a real dodgy, the last candlestick, the dodgy is basically where supply and demand actually meet. It is not indecision, it is liquidity or equilibrium. the balance. It is the balance. It is not imbalance. It is not indecision. Okay? So you can actually read on from this, look into the notes, and try to understand this. Then you have pin bars. Okay? This one, I will not actually talk much about it because you can actually read about it yourself. Okay? But first of all, I just want to emphasize, you can read the diagram. It is not because either bulls or bears were in control that a so-called significant level, which is support and resistance, it was because there was supply or demand at that particular point. Once at supply or demand, prices will actually do two things. It will either absorb all incoming orders, filling all passive orders, so a breakout is imminent, or it will fill only a number of orders, therefore a reversal is imminent. Okay? I know this is quite confusing at first, but later on throughout the series, you will start to be having aha moments. You'll be like, oh, okay, that's what it was all about. Then finally, you have supply and demand. So what are we? Okay? There are many kinds of traders, and I would love to call ourselves supply and demand traders. However, just like price action traders, there are many different forms of supply and demand traders. Specifically, we are supply and demand traders that enter at stop losses of retailers. Okay, so technically we are stop loss traders. So what are stop loss traders or sniper traders? Simple. The retailer's stop loss is where I'm going to enter. Therefore, my entry is almost always a precision entry. You can actually read more about this, and I want to show you a bit about supply and demand trading in the next slide, and how similar, no, not how similar, I'm going to actually show you the difference between supply and demand trading versus price action trading. Okay, this is how a price action trader will typically make his trade. Okay, we start from B1. Okay, B1 prices rised up to S1. Okay, so B1 became support and S1 became resistance. Prices fell down to S2, made a retracement, and fell down to the support of B1. However, you know the term, buy support and sell resistance. Many buyers were buying at the support level of B1, but prices broke out and landed at B2. Okay, B2 is where the stop losses of the buyers were located. So then, do not forget, S2 actually made resistance. Prices went up, a lot of people were selling at S2. However, it broke out of S2 and made S3. So S3 became the new resistance. Prices fell down, came back up to the resistance of sell 3, S3, but it broke out and made S4. From S4, prices fell down to the support of B2, and B2 was the only profitable trade. Okay, prices went up to the resistance S4, and many sellers were selling at S4. However, prices broke out, okay, and headed to the resistance of S1. Now prices reached S1, many sellers were selling at S1. However, prices made a fake out and then hit the stop losses of the sellers, and then it came down. So technically, out of 6 trades, the price action trader truly only won 1 trade. However, in comparison, this is how the Mintedseed technical analysis will look like. If you see the 2 gray boxes, the 2 gray boxes actually mark an order cluster. Okay, an order cluster overlapping. Therefore, we entered the first area that we sold was at 20 pips drawdown. However, it made up to 200 pips in profit. Okay, So this is actually how we analyze it. I know that it doesn't actually make sense right now, but once you actually enter section 4, we will explain to you exactly the meaning of all of this. And the second trade we actually made, we sold there at the end point there, 1.5 pip drawdown to 200 pips in profit. Okay. Now you counted the risk to reward ratio for me. Okay, maybe some of you are actually thinking right now, we just randomly drew this. I can assure you, this actually happens over and over again in the charts, and you will one day be, once you actually understand everything, you'll be like, wow, why didn't I see this coming? It was actually so simple. Okay, sorry. That's all for this particular topic. I'll see you in the next one.